So welcome everyone. This is our, I don't know, we're starting to lose count, 56th or 57th webinar since April. We're very pleased to have RBC this morning. And, you know, before I introduce Nathalie, who will introduce Mark Anthony, who's Mr. M&A in Eastern Canada for RBC, I just wanted to mention that, you know, it's so impressive what RBC is doing because many financial institutions say they do M&A, but they don't do what I call real M&A. So real M&A is what Mark Anthony does. He finds the buyers and sellers and matches them, which is of course the first huge challenge, and runs them, takes them through the whole process right up into closing, including looking after some of their other needs, like the liquidity event and what to do with things in their life and taxes and other things. Nathalie will speak about that, but it's very impressive that he has a large team that works at the RBC client base. Tony Lafreda, when he was in the job of Nathalie, told me at some point he had 10,000 commercial clients in Quebec. So maybe it's more now, but it's a great bassin client. So I'll introduce Nathalie briefly. Nathalie is the Regional Vice President for RBC. She's a Concordia graduate. She's a career banker. She's been a guest of honor at the Italian-Canadian Chamber of Commerce at a special prize giving ceremony. And what else? She's a solid supporter of the M&A Club throughout her banking career, of course. And we're very pleased that Nathalie accepted to bring Mark Anthony into our webinar series. And so thank you, Nathalie. Thank you to all the RBC team. And we'll let you take it away.
So good morning. Well, thank you, Bram. Thank you, Laureen, for this kind introduction, and of course for the opportunity to be with you today. So on behalf of RBC's entire team in Quebec, I'm so delighted to be joining you along with my colleague, Mark Anthony Serri, who's Managing Director, Mid-Market M&A Corporate Clients at RBC. So of course, we may be online, but technology for sure has kept us more connected than ever. But still, I have to admit that I'm so eager to see each of you in person and talk to you. My goodness. We can definitely start to see the light at the end of the tunnel, but in the meantime, I really do believe that we have to keep our resiliency, and we have to continue to be steadfast. So I know Mark Anthony well, and he's certainly prepared a very, very nice and interesting presentation for us today. To say that he's passionate about mergers and acquisition would certainly be an understatement. So I've had the privilege to be out in the field with my leaders across Quebec, and I've seen entrepreneurs choosing to sell their businesses and move on. Some felt like basically they'd taken their business as far as they could go, while others that have decided that they wanted to try something new or just retire altogether. But I have to say that some are still hungry and obviously looking for more challenges. And you know what? They're looking to complete some strategic acquisitions and further expand their business. So these are all good reasons to want to transfer a business. But no matter what the situation is, obviously RBC's team is there for the entrepreneurs to provide them with the real added value on both the personal and the business level. So the One RBC approach we take with all of our internal partners is quite unique. In fact, it calls for lots of collaboration, working as a team for our clients, not only to accompany them on the business side, but rather to provide a holistic offering with customized solutions for their business needs as well as their personal needs. So our size and expertise and products give the RBC team Quebec an edge in assisting these entrepreneurs. So starting with our team of commercial bankers, whereby we have more than 300 account managers across Quebec who provide strategic advice for financing, cash cash management, and leasing. So we have over 15 business centers located across the province, and we differentiate ourselves with our many specializations such as franchise and retail. We have some agriculture, agribusiness, knowledge-based industries, life sciences, healthcare, and of course our supply chain and diversified businesses. So when I think of entrepreneurs and the life that they've invested in their business, they're looking for advice, but really they're looking to be understood, and that takes time. As you know, we need to build these strong relationships where mutual trust is obviously at the forefront. So getting there is certainly not an easy task, because we have to customize our approach in order to adapt to these needs. And not to mention also the level of knowledge relative to the transaction that they're looking to accomplish. We're financial experts, and structuring represents our day-to-day. However, for some of our entrepreneurs, it's not the case, and getting involved in an M&A process can be frightening as they're traveling in uncharted waters. So we can talk about completing a strategic acquisition, where we need integration and therefore a greater understanding of the business. But also, we can talk about selling a company that was built over a lifetime and even to consider several generations. We need a different approach, where we approach with care, with empathy, and definitely support throughout. So finally, we need to think of the overall picture, because at the end of the day, to ensure the transaction is a success, not just on the business side, but also on the personal side, the personal needs have to be addressed. And therefore, we need to ensure that wealth management partners are introduced and that the proper tax planning strategies are completed to deliver a holistic solution to the client. So as you can see, it's really paramount to know the customer, have a deep understanding of their business. Because otherwise, we can't provide the advice that they need. We need to offer a wide range of useful expertise to our entrepreneur. And at RBC, we refer to that as value beyond banking. So Mark Anthony, I know that you've prepared this lovely presentation for us. I'll hand it over to you so that you can give us a perspective on M&A trends, the outlook for the future.
Thank you, Nathalie, very much. So, another summary of that is that if you need to sell your company, come see me. If you need money or capital, see Nathalie and her team. I'll go ahead and share a presentation as we go on. We'll be distributing this presentation for all of you afterwards, but I think there'll be some insight in our discussion. And I definitely will be missing the exchange that we typically have. And for all those already sending me texts or emails or chats here, I'm just saying hi to everybody. I'm acknowledging that receipt, and I hope to catch up soon. So I've been asked today to talk about M&A and the outlook for 2021 and the impact on transactions going forward. But I want to start off with the recovery. So we saw a slowdown in the summer once we were in this situation, but then there was a recovery, and a quite remarkable recovery. So I want to touch on that as well, to talk on that. And towards the end of the presentation, we'll be concluding to talk about timing and the impact of timing on transactions, what could be done. So first, from a recovery standpoint, a lot of the recovery came from transactions that had commenced pre-COVID and that were far along in the process. So for instance, in our situation, toward the end of 2019, beginning of 2020, we were far along in a number of transactions. And that took us to a point where there was this uncertainty in March and April. We had to make a decision, are we stopping these transactions? What can we do to keep them warm and keep some type of pace during this uncertainty, and also to keep buyer confidence in this? So we spent a lot of our time really lowering our expectations coming to transactions with the buyers and our clients, which was really about let's keep in touch, let's keep sharing information as things go out, so we don't have as much take as much time to catch up afterwards. And that proved to be, a positive strategy where everyone was staying aligned. So these, pre-COVID transactions kept moving at a good pace. And we had our mid-market M&A team had the first closing across Canada end of July. It was in the construction sector. And that was also, I have to say, an awakening for some of the buyers as well, because during that process, there were some buyers, international buyers, American, that were looking at it and saying, you know what, we're just not doing a deal in May or June or July. We're just not there. So when we did close in July, many of these buyers contacted myself or our client or even the buyer, and they were asking the question, how did a transaction get closed in July, amid of this uncertainty? And they realized that they were missing opportunities. And they said, well, if some people are doing deals, like we got to be, doing that as well. And I started to see this in the summer as well, as deals were still getting closed, that the buyer sentiment started to get more positive. So you know what, we might be missing opportunities here. We're forgetting to look at this long term. So this was something that, we helped participate in that changing of that momentum, where things started to pick up as well towards the fall. With this, we had a second closing in September, also a transaction that was probably earmarked to close, May or June, pre-COVID timeline, and we ended up closing it in September. It was in an interesting space as well, so it was in personal protective equipment, and it closed that deal end of September, and there once again, buyers that had been in the process reached out and were also questioning, like, this is very interesting to see deals getting closed. So this was a good shift in the momentum, and we saw that ramping up as well going forward. And also, to the second point here, more of a sector focus. So sectors that were resilient throughout COVID, showing positive results, we're getting much more attention, and we're favorably positioned, for these market conditions. And we'll get to some sectors afterwards that we saw that were part of the recovery and performing better. During the process, and the third point, there were some companies that weren't in sectors that are favorable, or might have been in some decent sectors but struggling, and some of these companies had to close on deals in less favorable conditions. Like, we don't do distressed M&A on our team, but we were getting a lot of calls from investors or buyers looking for distressed assets. So that wasn't our focus, and never was our focus, but we saw deals closing in that space. The last point, although there are many points to the recovery, I'd say is the last point that really helped the recovery in M&A is technology. Technology played an important role in getting deals done. So whether it's virtual data rooms, video conferencing, other analytical tools, and coming from a technology background in a public company, one of the biggest struggles you have with technology is adoption, and adoption is usually over a longer period of time, sometimes 3 to 5 years, and a lot of that adoption happened in a matter of weeks where we went on. So really, everyone adapted very quickly, as you can all tell, but that had a very positive impact on recovery to M&A. Now, some points on the outlook for 2021. What's going to impact and drive M&A in 2021? For the markets, what we're seeing now is private equity playing an important role, fundraising that's happening as well during this process. We've seen local players here raising capital as well, either private equity or other earlier stage companies. Companies having record cash balances as well, more deal flow, and of course the low interest rate environment is going to help drive M&A. Valuation multiples are resilient for interesting sectors and companies, and we'll touch on that. The ability, I think we're still seeing more momentum and growth in virtual deal making and finding solutions to get to that point. And of course, the other element impacting, driving M&A in 2021 is the pandemic trajectory. So we'll touch on those points a bit more in the following slides. And once again, please collect your questions. We'll be able to answer them at the end of this. So what we're seeing in 2020 and also into 2021 is there's still record capital out there. So there's a lot of capital to be invested in transactions, and that's having a positive impact in the recovery. For those that the 2008 drop, that was really a financial crisis. Now we're having a health crisis, and capital is available. When I sold my company, it was just at the start of 2008, so we saw the crash coming, and divested the company that I was in, and then after that, it was just really tough recovery. This one here was very quick, and there's still a lot of capital out there to do deals and deploy that. We see that through not only research but also communications. So our team, we're about 35 sell-side M&A advisors within RBC across Canada, and we're constantly being solicited and contacted by private equity firms from around the world, even, but mostly from North America, to better understand their investment criteria. And we're a very strong hub to understand where they're coming from and bridging in with our own network internally of companies. As Bram mentioned earlier, there's a lot of companies that are in our pipeline, and that we're looking for solutions. And I think what our important role we have here in 2021 is really to celebrate the entrepreneur. I think the entrepreneur will be at the core of this recovery. Once we have our frontline workers doing their job, keeping us all healthy, I think next in line will be entrepreneurs to ensure that there is that job growth. Growth will help with the recovery tremendously. Deploying this capital will help with the recovery. So I think we're all here on this call to help celebrate and help prosper support the entrepreneurs. So further from volume, why I wanted to show this slide is that in 2020 we saw the drop in M&A, towards the middle of the year, but then a recovery afterwards. So what that means is that we're seeing the momentum, the trends going well, but it also means that for a good part of last year, a lot of capital that was available was not deployed. So there is, and when capital is not deployed for private equity firms, it does affect their returns. And there's some catch up to be done. There still is that capital to be invested going forward. And especially in these environments, how do we help everyone deploy that capital and help realize that growth? So a lot of resurgence we're seeing in 2020. Out of the past 10 years, it's still a top 3 year in terms of deal making. I think we have a very, very exciting year ahead in 2021, which will carry into 2022. So all of us on this call are going to play, I think, a crucial role in helping get those deals done and helping with this growth as well. So there's, I think, a peak in 2021 that will come from various sectors. There's sectors that are being favorably impacted by COVID. Those working from home, obviously, versus work is impacting the food sector. Hospitality decline is impacting the food sector as well. Some positives, some negatives. So we're currently doing deals in the food sector which are very, very favorable. Logistics as well. So as we're looking at online sales and the impact of logistics from that standpoint, or logistics on food or other niche manufacturing and distribution. So logistics showing some interest. Technology, another sector, as we mentioned earlier, adoption is being accelerated with these conditions. So I think all the readings we've done on change management could be put aside because of this pandemic. Like the change that's been adopted is and accepted is tremendous and had a wonderful effect on technology, the demand and the churn. So very low churn in technology once it's been proven to being used. So people are sticking to technologies. Gives an opportunity for startups as well because there's a lot more ideas coming up. There's many more issues and problems coming up that are being resolved. Business services as well. We're also doing a deal in business services segment, and where everyone's working from home and leveraging technology to provide those services to clients, which might also be at home. So business services is an interesting sector to be looking at. You know, sanitary industry as well. We're also doing a deal in that space. So whether it's impacting water treatment or sanitization products or protective equipment, you know, health and safety. So those are interesting sectors to be part of. You know, the impact of travel. There's a lot more local spend and disposable income versus spending abroad. In terms of real estate, there might be some urban planners on the call as well, but from a real estate perspective, you know, reimagining interior design, reimagining, you know, HVAC systems. You're seeing one of our clients as well working in there, finding solutions for HVAC systems, energy efficiencies. So I think there's a lot to look at in that space as well, and the services around it. From that leads us to talking a bit on financing, and maybe I'd invite Nathalie to chime in at this point as well. But you know, financing is playing a major impact on M&A and structuring deals. And in our case, I'll get back to it later on as well, but there's a lot of collaboration between my team, Nathalie's team, and regarding financing and how we can get to a close earlier. So there's a lot of deals that we're looking at together, and I think it's worth you know, sharing that a bit more.
Thanks, Mark Anthony. So yeah, absolutely. And I just want to say, you know, you said something earlier, celebrate the entrepreneurs. And my God, do we have to? Because yes, the healthcare workers have shown so much resiliency, but the entrepreneurs as well. They faced this storm head on. And a lot of them, I've noticed, have changed their business model to adapt to what has happened, and have come out of here so successful, and reimagined their business. So I think that's definitely to be celebrated. So one thing I'd say about, you know, the financing is to be early. Because the earlier you are when you socialize the deal with the financial institution, it will facilitate the process going forward, because of course we have a better general understanding of the business. And sometimes we need partners to finance the contemplated acquisition. And when it's last minute, it's more difficult to gain this deeper knowledge, right? And to introduce the right partners to provide a customized solution. Also knowing the customer. So are we knowledgeable of the industry? And what's the investment thesis behind the deal? Because that's going to drive a lot of their decision making. And you know, shareholders, are they sticking around or not? And if so, under what circumstances are they sticking around? Key employees, all that. We really, really need to have this understanding, because that management team will definitely determine the success of the company going forward. So coming back to the basics here, I'll start with the equity. So to me, you know, we're always looking at a minimum of 25%. And from that base, you can then after build up your structure. But it's important also to realize that today there's a lot of liquidities in the market. And, you know, you saw that the slides Mark Anthony showed before, there's money. Money is available. So the more you can put into equity, the more flexibility you can have going forward. You know, the balance of sale as well. So if we have the shareholders that are willing to put in a balance of sale, well, under what terms? And how is that going to impact us going forward as well? And have the selling shareholders accepted the earnout, and how's that going to impact future cash flows? And has there been a sensitivity analysis made around that? Because we need to understand, right? And so all that needs to be considered before we even look at what the senior debt structure can be. And the loan structures need to be customized, and they need to be made available either through a conventional deal, whereby we're looking at the basics of the operating credit and the term debt, but through an ABL deal, which could provide so much more flexibility, right, with very, very minimal covenants. And that's something that not a lot of entrepreneurs know about, but definitely it can bring them to a greater flexibility going forward. And finally, the hybrid structures. You know, when I think of hybrid structures, considering the mix of sub-debt and mezz financing, you get, like in the sub-debts, moratoriums, which will be matched to basically the cash flow requirements of the company over time. So if you're dealing with an enterprise that has a volatile peaks and valleys instead of like your historical, very, very stable cash flow, well, definitely a customization will be much more welcome in those circumstances. But at the end of the day, you know, the business model and its cash requirements will drive the structure. And that's why the deeper understanding of the business is so necessary. There's been a lot of talk in the market about the amortization of these debts, and a lot of them are going up to 10 years. And yeah, that's good. It is flexibility. But at the end of the day, you know, as a good advisor, we need to understand how this will impact the company in the later years. So if we're still paying our debt at the 8th year, you know, I'm not sure that there's enough capital thereafter to put forward for expansionary moves. So, and other acquisitions, right? So all this needs to be considered. So leverage is a nice word, and some like to stretch the envelope. However, you know, as it's stated on the slide, the prudent use of capital structure will definitely increase the overall returns. So Mark Anthony, I'll give it back to you.
Thank you, Nathalie. So appreciate that. And, you know, I think it's great to have the opportunity to do M&A with a balance sheet, you know, and, you know, doing this work beforehand really helps. And I'll touch on that a bit later on. So thanks again, Nathalie. And, you know, to our valuation trends, and I'm sure most of you get sometimes calls saying, what's this company trading at? What's the multiples for the industry? And in general, for, you know, discussion purposes, multiples are used, but we're always building a much more detailed projections and business case to support that. And the multiple is actually the result of doing all that. But today, to add to the complexities of a multiple is to what do you apply the multiple to? You know, we're talking about EBITDA, normalized EBITDA, adjusted EBITDA, and now an EBITDA adjusted for COVID. So, and I'm not a real fan of any of those terms. You know, it's really understanding cash flow and underlying risks. But having said that, as some guidance here, overall, what we're seeing in the industry is a dramatic recovery of multiples that have proven very resilient across a number of sectors and companies. And, you know, and in some cases, multiples have reverted back to pre-COVID multiples or even over and above what we've had. So the market is great, and this is really helping push towards very exciting times in M&A for the next while. Out of this, I think a segment that sticks out the most are transactions between 50 and 100 million, and that's the light blue bar. You'll see historically that you know, there's been you know, as low as 7 times multiples in that space. Right now, being at 8 times is showing strong recovery, a lot of interest in that space. It's a nice space for strategics to start looking at doing deals. You know, P funds as well. So they're getting a premium multiple. A bit more stability for deals over 100 million, but still strong multiples. And you know, when we're looking at, you know, 150, 200 million above, you know, you'll often see multiples north of 10 times as well. And still, you know, the deals under the 25 million, which is the first bar, all is around the, you know, the 5.8, 6.2 times multiple. And then the 25 to 50, you know, all is between the 6.5, 7 times multiple. So this gives some guidance, but I can't emphasize enough the work to be done on cash flow and understanding the risks. For those, that have worked on deals with me, will always understand how we put culture first, and culture is the most important element of any transaction. Today more than ever, what's the impact of a company's culture on multiples? That culture will have helped dictate how they've treated or prepared for a pandemic, how they've responded accordingly, and how easy or not it was to adapt solutions across the company. So through employees and clients and the whole supply chain. So we're seeing culture have a major impact on that as well. So from a multiples perspective, strong multiples are continuing. And from EBITDA, I think we've worked on all transactions where we're normalizing EBITDA to see what is the recurring EBITDA going forward, but also with COVID, there's two things happening with COVID. There's the COVID bump, where some companies are performing extremely well in this environment, and buyers and investors are looking at their EBITDA and saying, okay, is this really sustainable? How much of this COVID bump is sustainable? How much is it a true shift in demand versus just everyone having breakfast cereal in the morning, which might not happen anymore in 2-3 years. So that's something that there's a lot of work being done on that to better understand it, and that's also having a major impact on the structure of a deal. So there's also the other effect where COVID has either eaten away at revenues or pushed out revenues or pushed out some backlog to future dates, maybe some additional non-recurring expenses as well. So the same uncertainty there. How much of this will there be recovery going forward, or how much of these expenses will go away once we pass this scenario? So structure is having much more important impact on deals today, but also you'd say probably pre-COVID, we're seeing deals getting closed. It was rare to have earnouts or major holdbacks or escrows or vendor takebacks, but I think COVID brought that back to some transactions where, because of this uncertainty, to actually get down to what is the cash flow, that structure is coming in to mitigate that with earnouts, sometimes a vendor takeback, or some other type of holdback or escrow. So that's, I think we're seeing that more often. The opportunities that are extremely interesting in the right sector, in the right space, and a better understanding of risk might not necessarily have these more complex situations in their structures. So from that, I think it's an interesting time for entrepreneurs to be looking at ways to execute on their growth strategy, and often through acquisitions or partnering with someone stronger or exiting to having someone else continue that story is it's a great opportunity. We know that those that have assets and asset holders are making it very interesting for them. Those that have capital, it's very interesting. Unfortunately, those that aren't asset holders will still be struggling going forward. So, one question I'm getting a lot is, are there more sellers today than pre-COVID? Are there more buyers today than pre-COVID? From the seller standpoint, I'd have to say I think there's a lot more that are questioning selling their company. A lot of them are also looking over their performance over the past 10 years. But those that have not performed well over the last 12 months are not able to predict properly the future of their business or the impact post-COVID. Although there might be sellers, there might not be an interesting market for them, and they might be best off waiting to see some stability and tracking their monthly financials, so they have a good track record to with confidence approach the market. So although there might be sellers, I'd say they'd be qualified and maybe not the right timing now to look at them, and others are just performing extremely well, right? So those that have done extremely well are online companies, businesses that are growing exponentially and generating a lot of interest. Niche manufacturing companies, niche distribution companies are extremely interesting. So, they might not have been sellers before, but because of this favorable transaction market, market with low interest rates as well, we're seeing that this could impact deal making. I touched on it earlier as well. I think what's important is behind the technology in virtual deal making, there's still emotions and humans, and we cannot forget that factor. And I think we'll be successful in every transaction that's mainly done virtually if we still lead with empathy. I think pre-COVID, we'd spent a lot of time getting to know our clients. But I think post-COVID, it's more than that. It's getting to know all the parties involved in a transaction, be it the accountants, the lawyers, the buyers, the sellers, the members of the management team, and getting to know them as well, because everyone's living their own situations, whether it's with kids or their parents or others that they're caring for, or their own health situation. So I think, although we need to drive transactions to a close, we got to be able to balance that with empathy and making sure everyone is moving in the right direction, but we're allowing some of that flexibility. I also feel that not every call needs to be a video call. I try to limit video calls as well, and unless it's extremely necessary, just because, for one thing, I'm not a fan of seeing myself in a small corner somewhere, but also I'm not a fan of having everyone come to this and sometimes get distracted by looking at a camera lens or trying to look at the video as opposed to getting into their inner thoughts and thinking more. So I still prefer phone calls versus video calls as well in a lot of situations. But the in-person, we're working several deals now, and we've all had in-person meetings at some point, respecting social distancing, and moving forward that way. So there might be, probably are some people on this call. I know there's a lot of advisors on this call. There's other capital providers, whether it be debt or equity, some entrepreneurs. Perhaps some of you have closed deals 100% virtually, but I don't see that happening in our situation. We had a recent due diligence, and we did as much as we could at a distance, and then finally had some international investors come to Canada to complete due diligence and made sure to get the an exempt status to do this because it was a crucial point of the due diligence, and this was something that was interesting to get done. But I think in my case, I think we'll have different views on that. But I think unless there was a prior relationship or prior due diligence done, I think the in-person needs to be there. I also know that I need to get that feedback too when I'm seeing buyers and getting everyone in one room, like we did last week. We're about eight participants in a very, very, very large boardroom, respecting our distances, keeping our masks, hand sanitizing, and being respectful that way. And everyone adapted extremely well. So virtual deal making will help us get further along in the deals, but I think there'll still be that personal component. As I see time going on, I'll maybe just wrap up to the points you've touched. So there's a lot of capital out there, a low interest rate environment, capital that has not been deployed last year that needs to be caught up and invested now is really going to be driving M&A. So once again, it's a very exciting year for all of us in M&A. We're very fortunate to be in this sector. It remains exciting to be part of. But the question is, what can we do to better prepare? Without getting into all the steps, from a high level perspective, there's really 3 phases to deal making, and I think most people follow this process of preparation. And the phase 1 and the phase 2 is contacting approved buyers and investors, and then phase 3 being exclusive and closing a deal with one specific buyer. I would just like to focus on this timeline, which could be 3 to 6 months, on the preparation phase, because what's going to drive value as well is not only preparing very well for due diligence, but also preparing well from a financing perspective. Because when buyers or investors are looking at opportunities, they'll be very attractive attracted to an opportunity that they feel they can close quickly as well. Buyers don't want to spend 6 months closing a deal either. You know, when they're very interested, when it's strategic and there's capital to deploy, they want to move quickly on that as well. So that preparation is very interesting. And, you know, as you mentioned, when I work with Nathalie or others of her team, when it's coming to a financing solution, you saw the complexities of financing. You know, it's not just about the interest rate. It's not just about the dollar amount. It's about the structure as well, and positioning the company for growth, and leading with advice as well, you know, and ensuring that, you know, entrepreneurs start to participate in that financing and saying, well, if I'm going to be staying in the company going forward, what would be my ideal scenario? And what could we present to a buyer? And then buyers that are strategics and looking at this and looking to close the deal quickly, you know, we come up and say, you know what, 3/4 of the financing package is prepared. We just need to complete that analysis with your own profile and what you plan on doing with the business. So that's really appreciated by any buyer that we will present Nathalie or her team to help complete that. And, you know, we've done deals, you know, with others that are most likely on this call or this video conference as well, where we're partnering with others as well to complete deals as well. So there's solutions that we're working together. So really appreciate all of that. And that preparation stage works on all ends. You know, if you're looking at deals and need to prepare better, we can help with that. We can help complement it with financing or complement it with an M&A strategy. So I think preparation will also drive a lot of value, because buyers will be interested to see that the risk diminish there. So as I see, we're getting close to time, and I know there's questions coming in, and sorry I'm not answering them on the fly, but we'll get to them. So there's timing that's important. I think staying calm and cool throughout the transaction is extremely important. I think that's our role here, to make sure everyone's moving along in these, you know, challenging times, and, you know, leading with empathy. And for this exciting year, I think, you know, as Nathalie repeated as well, it's a great time to celebrate our entrepreneurs and all the risks they're taking, and how we can help them realize their full potential through M&A acquisitions, or selling their companies, or partnering with the right players. So perhaps at this point we can turn this around to some questions. Lorraine will be giving some questions, or
maybe I'll chime in, Mark Anthony. Sure. I'll read them off to you if you'd like. Okay. But well said, first of all, on the how, because you know what, we're all numbers driven and deal driven, but at the end of all this, though, or behind all this, there are people, and adapting to them and understanding their daily circumstances and the impact that this pandemic has had on everybody is so paramount to the success of a relationship going forward. So the first question is coming in from Melanie Russell. Are these general multiples, or are you talking about specific sector?
Yeah, so thanks for your question, Melanie. So these are general overall multiples based on the size of the transactions, and I think getting into more specific sectors requires more analysis. And when we're looking at multiples on a specific sector, we'll try to also understand the underlying business model of that business sector. You know, how much of that business model is recurring versus one time, and what is the growth historically that the company has had? What are the growth prospects? So we'll do more work on that from a sector perspective. But yeah, these are general multiples.
Thanks. So a second question here from Jonathan Brindley. What impact, if any, has the various government relief programs had? Example, the employee wage subsidy, rent subsidy, so on M&A activity plus company valuation. So has they increased the need to normalize results?
Yeah, also a good question. So from a wage subsidy perspective, we're excluding all impact of this on cash flows. So just to get to a normalized level. So we'll spend more time analyzing that. But I think the greater challenge there is what's the impact on productivity? So what's happened is we've seen some companies that have had wage subsidies and had production drop off. So what has been this reduced production? What's been the impact of this reduced production on their numbers, and how will this help going forward? So that adds that complexity to valuations, and probably impacting much more on the structure side than the valuation side. But it is impacting production. With other measures, there's not only just financial help, but it's also the additional conditions that governments have put in place for entrepreneurs to run their businesses. In some cases, these have been proven difficult or stressful for employees, so they're working from home and might not be as productive, or the learning curve is pushed out, especially for those starting off in new positions, where it's been proven through studies even before COVID that learning curve is accelerated when you're in a working environment and working with others and learning. And although it's 25 years I'm doing M&A, I still learn from the environment that I'm in. As much as I love my 8-year-old daughter, doesn't help me too much in the M&A world, but I'm reconnecting with a lot of storytelling, if you want to say. And so I think that's having an impact on valuations from wage subsidy perspectives. Other circumstances, let's say in construction, what impacted valuations is productivity is even better. They found that there's actually less talking on site, and people are keeping much busier as well. So some sectors are showing some favorable, I guess, some outcomes that were not necessarily predicted at that point when these measures were being put in.
Excellent. So the next question comes in from Feroz Austin. So first, thank you for the presentation. Well, it's kind of you to put this comment. As capital is available to be deployed and the pandemic has highlighted resilient companies, sellers versus non-performing companies, does this situation lead to irrational exuberance in terms of pricing for those performing firms?
When I was looking at transactions 15 years ago, there was a lot less capital. You didn't see family offices getting into the space. It was still a smaller market. Those who were around 15 years ago can just remember, just in Quebec, who the player was doing transactions in the space. Since then, there's a lot more sophistication in the process, and that's keeping things rational. There's a lot of due diligence that's being done. You can see across the markets, or even advisors on this call as well, that there's a lot more experience in due diligence. Before, even 15, 20 years ago, due diligence was often done by auditors and accounting firms, and it's very different when you're doing a due diligence versus an audit. It's not the same thing at all. But back then there was a lot of that hybrid role. Today, there's a lot of experience out there in terms of doing due diligence. So the results of those due diligence are helping motivate a close. When there's a cultural fit and strategic fit, that gives the momentum to then iron out the balance of the risks that are being shared between the buyer and the seller. So I wouldn't say that if there's anything irrational happening in a deal, my recommendation is don't approach it. If it looks too good to be true, it probably is. I learned that lesson in New York when I was 17 years old. So if it's too good to be true, just pass. Stick on one that fits your cultural fit, strategic fit, and financially you'll get there. It'll make sense.
I like that. All right, so we have another question coming in from Danielle Titleman. So PwC claims 53% of the executives in the US plan to do more M&A in 2021. So which industries do you expect to see the most amount of consolidation this year? And there's a second question by the same gentleman that says also, given the amount of liquidity, dry powder available for M&A, have transactions during COVID been more friendly or hostile? So perhaps those two questions.
Sure. I touched earlier in the presentation of sectors that we're seeing getting a lot of interest. So, you know, niche manufacturing. So I think first, the size of a company will continue to drive this, and consolidating larger companies that then become a stronger platform to acquire smaller companies. So there's still a lot of sectors that need to be rolled up. You know, I think when you're looking at niche manufacturing, I think that remains extremely interesting because the right combination of niche manufacturing companies provides a very strong company with overall, you know, a supply chain solution that can make things very, very interesting. Still, in terms of distribution, a lot of companies are looking to leverage their brick and mortar distribution to the new logistics solutions and technologies, and leveraging artificial intelligence across platforms. So I think the traditional matrix of consolidating companies, where you can leverage admin and financial savvy and clients and suppliers, will introduce technology. You know, so when you can master or find great AI solutions that can be applied to your company, to manufacturing or distribution or business services, and then leveraging that across a platform will help drive that as well. To the second part, friendly or hostile. If we feel that there's someone that's being hostile in the process early on, they're usually eliminated. I don't spend much time with anyone that's not respectful, hostile. You know, it goes back to culture. I don't care where they come from or what capital that they have. If not ready to work in a friendly, empathetic environment, I'm just not interested to transact. So those we try to eliminate them at the core. But I have to say the vast majority are friendly and professional and really focused on getting the deal done. You know, like I'll say to a lot of people that my boss is the deal. I work for the deal. My entire team works for the deal, and our clients and buyers are supporting to help get this deal done. So it's not about egos, and usually those with putting ego first aren't deal makers, and will just make a transaction suffer and waste time. So I appreciate that question. You know, so my approach is, if you feel there's some hostility there and it can be resolved, or get the right people in the room to get there, I find that entrepreneurs, you know, might have someone on their team that might be a bit more hostile, but the actual entrepreneur, business owner themselves, is much more reasoning. So we want to do the attempt to get the right people in the room to find out, is this hostility part of the culture and embedded in everyone in the process, or is it just isolated? And if it's embedded across the company or the entire team, then we'll most likely pass on that buyer.
Thanks for being so candid on that second part of the question. I think it's super important, you know, to put that out there. And as you said, a culture is the most important thing to drive this at the end of the day, right? So I moved on to the chat. There's a couple of questions that came in. So Yannick Trollet saying, which is a good one actually, how do you get preference status for getting someone to come in from the US? Or better yet, how do we get one to go to the US for closing a deal? Yeah, that's complicated these days.
Yeah. Well, you know what? That's part of the secret sauce, and I'm happy to help you out on that one if you want to reach out to me directly.
Awesome. Okay, very good. And then the final question, Jonathan Latsky. I gather PE firms have a lot of dry powder. What about strategics? Are they flush balance sheets motivating them to make more strategic acquisitions? Are PEs looking at strategic tuck-ins for their portfolio companies?
Yeah, so for strategics, you know, their options really are, you know, dividends, buying back share buybacks, or investing. You know, shareholders will have one view, the CEO might have another view, the board might have another view, but in general, there was a turning point in July where there was a shift from uncertainty to more urgency of saying, well, okay, these are great conditions to be acquiring companies in. how can we deploy this? How can we take advantage of this? You know, so a lot of companies, although they might not have needed it, started to renegotiate their financing terms to provide themselves some flexibility to be able to increase some margins, maybe get an acquisition line, starting to do analysis, see how quickly can they deploy this capital and take advantage of this scenario. So it was no longer a situation of doubt. Should we be doing M&A? It was more about, okay, how can we get into the game? How can we do as much M&A as possible during this environment that is really promoting growth and growth led by entrepreneurs that will lead the economic recovery and job creation here. So there's a lot of capital out there, a lot of structures, and we're seeing that where great opportunities are getting a lot of attention, and that strategics want to be investing that capital in this environment.
Awesome. Well, thank you for this. So then this brings us really to time, and I want to thank everybody on the call today for bringing forward their questions. And I hope, we're hoping, you know, Mark Anthony did an awesome job by giving you the outlook, the perspective, and answering those questions. So we're hoping that this was very insightful for you, your prospects, and for the runway that's in front of us to make 2021 a successful one. So thank you again. Bram, I hand it over back to you.
Thank you very much, Nathalie. Thank you very much, Mark Anthony. This was obviously most useful to hear it from you guys, especially on the higher end of the mid-market, which is, of course, where the M&A Club positions itself. We've kind of left the lower mid-market behind in most ways, and we're moving up. If you remember, a couple of years ago, we had at the gala, at the M&A Awards Gala, as long as one company, we don't do public companies, you know, public company awards, but if at least one of the parties is private. Remember, we had this company near Magog who was sold for 2.3 billion Canadian to Michelin. It's really interesting to hear from RBC about the mid-market, of course. So thank you very, very much for this illuminating presentation. And we hope to have you back in not too long and to see how 2021 is going.
Absolutely.
Just a word about the M&A Club. We're, as I say, positioned in the mid-market. Our webinars are producing a lot of new contacts amongst the people across Canada, our 1,000 members. It's actually a bit of a silver lining, the whole COVID thing, because we never were connecting our members that way before. And now there actually have been transactions completed through the contacts in the webinars and the M&A Club Connect, which is a virtual roundtable which we do once a month. We also have our deal listing, which last one was 40 pages of deals and services opportunities from our members, open, of course, to members only. That's every 2 weeks. That's published in a PDF, and soon on our new website, which is coming very, very soon, in possibly days, finally, there will be an interactive element where members can talk to each other about their deals and put up deals and take down deals, etc. More about that later. Back to the M&A Awards Gala, we're hoping this year to have it November 18th. That's the date that's booked at the Windsor, Montreal, and a few weeks later in Toronto at the King Edward. But of course, we're all standing by on that one. It's very interesting to read in the Wall Street Journal how the US economy is starting to tick up, and in terms of employment and people's outlook, and obviously that's going to have a retombée, that's going to have you know, a positive fallout in Canada. So we're very optimistic, and we agree with Mark Anthony. Mark Anthony, you were telling me in the preview that this was your best year in the last 5 years. And so congratulations on that. And you want to just say a word about that? That's amazing. That 2020 was your best year in 5 years, because 2019, obviously, 2019 was a great year.
Yeah, 2019 was a great year, and 2020 was a great year. And you know, with the team that we have and a lot of the work that we've done, so that was a great year. But also a great year, I think, to share some talent and time for the community, you know. So being a board member of an elementary school, you can think of all and treasurer, the issues we have to get through there to manage that, and as well as being part of the Italian Chamber of Commerce and how to struggle through that. So I think that was very important as well. So overall, it was a great year, and we're looking at 2021 to be even better. So.
Well, thank you very much, everyone. Thank you to everyone who's participating this morning and the people who ask questions. We have more webinars coming up very soon. We have the chief economist of Scotiabank is going to give us an update. We have a conversation about investing in Asia coming up. We have Ipsos. It used to be Ipsos Reid, if you remember, the great, one of the major, if not the major Canadian polling company. The CEO, Daryl Bricker, is going to be, I think it's March 24th, but you'll be getting a notice on that. He's going to update us on what's going on in Canada, a lot of demographics and metrics that we don't think about, immigration, et cetera, et cetera. That's really interesting points of view to get that point of view from someone else, you know, in that field, and things that we should know that, as I say, we don't think about. So with that, we'll say goodbye and have a great day, have a great week, stay safe, and
Thank
we'll
you,
see you
Brad.
at the next webinar. Thanks, RBC.
Thank you again. Have a good day,
Thank you, Brad.
everybody.
Thank you, Davin.
Thanks to you both.
Bye.
Bye.